I'm not saying don't get a CFA, don't get a CAIA or an MBA, but you don't need those things to understand the mechanics, the operational backbone of an investment. But if you understand the operational backbone of an investment, then you can understand truly how performance is calculated, then how something's performing, and take that every step further. So
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Will AI replace the venture capital fund investor? Today, we have the person to answer that question. Apurva Mehta is the co-founding managing partner of Summit Peak Investments with almost $1 billion, billion as in B, as in big, in assets under management, where they invest in transformational companies and primarily in venture capital funds. He's created and helped create programs at Cook's Children's Healthcare System, Juilliard, yes, the music one, just to name a few. We talk about the things that the Lehman Brothers did right despite its place in history. How does AI affect a new LP's attention to detail? And how does one build a VC portfolio from scratch at an endowment foundation worthy of being named the top 40 under 40 by the CIO magazine? I've been looking forward to this conversation since my buddy Rahul at Nomo Ventures put us in touch. So, without further ado, Apurva Mehta.
Thanks, David. Appreciate it. Happy to be on here.
We love starting from your personal background. And this is something we do on the podcast. And I'm really curious, for you, where does your fascination with tennis or the US Open come from?
So tennis in general, I played through high school. My wife actually played in college. We go to Wimbledon every year, or we try to over the last couple of years, actually.
Is that where your LinkedIn photo right now?
Yeah.
Yeah, Wimbledon?
Yeah. So that's at Wimbledon. When I was at Lehman Brothers, we had amazing seats to the US Open. And my now wife of 17 years, our third date was Agassi's last match at the US Open. So there's some nostalgia around going to the US Open. But yeah, I watch it religiously when it's on. Wimbledon too, so all the majors, but then also, all the small ones, the Cincinnati Open and the Miami Open. So I've loved watching tennis, for the last 25 years, 30 years.
Lehman is a more than obvious name for many of folks in our audience. What was that emotional journey like when you were at Lehman? Because I believe you were there 04 to 08, give or take. And so you've seen both the peaks and troughs of the institution. What was that like?
Things that I've learned, or things that I learned there that I don't know if they would be valuable today. For me, they were, meaning, and I say that, the Gen Z era might not need to know how to use Excel or PowerPoint. And I know that AI and the use of AI, everyone can leverage those tools. But, the things that I learned were attention to detail more than anything. They are core skills that might be lost on a new generation. So I learned a ton. I learned a ton about, kind of the rise of, Lehman. In my early days, we had a road to 150, which was, our stock price was at 75 at some point, in 04 or 05. And the road to 150 meant, if we got our stock price to 150, that, meant a certain level of earnings. So got to see its rise to that. The good decisions that we made, I guess, as a firm to get there. And then in kind of that 07, 08 timeframe, probably the bad decisions, at least from an investment banking perspective. There was a lot of things that, you could watch documentaries to understand, call it the missteps made at Lehman Brothers, of, its eventual, demise. But on the investment banking side, there are a lot of things that might be more obvious, in hindsight of, where that just was a great learning experience. So the emotional journey, one of the best times of my career. Every role in my career since has been one of the best times in my career, but I just, don't regret any aspect of being there, learning, working with the people that I worked with. They all still work at Barclays, and/or Neuberger Berman. So I spent the last 6 months of my Lehman career on the investment management side because I eventually wanted to get back into investment management. So, my old teams are still at Barclays, Neuberger, and they were just, phenomenal learning experiences.
I wonder, and I don't have an answer for this, I'm curious on your thoughts on this, where today there's the, let's say, Gen Z, I'm generalizing here, but the Gen Z person using AI tools to build spreadsheet models and portfolio construction and all that kind of stuff. And they eventually present it to you. And you become the human component that helps them check their blind side, test their assumptions, and see if it actually makes sense. One day into the future, these Gen Z individuals will be the senior people on the team. What are the things that, let's say, that the younger talent of today or the newer investors of today should be aware of when they're leveraging AI tools so that by the time they become senior individuals on an investment team, that they won't lose that skill set and that you think that skill set is still important as a part of investment management?
It's sure you can leverage all these tools, but it's understanding the data and telling the right story. And telling the right story means knowing your audience. You really, so whether it was at Lehman Brothers, it was the executive committee of investment banking, or sometimes making presentations to the firm's executive committee, and knowing your audience. And, a mentor of mine at Lehman said, we can prepare this every Friday night. We'd send out the last FedEx of the night that went to the executive committee of investment banking. And we can prepare these materials and it would be a stack this big, but we have 1 minute of their attention from the first page of this. And what story are we trying to get across from that? Everything else backs this up with lots of data. So if they want to dig in, they can dig in. If you're the head of M&A at the time, it was Mark Schaefer, who, if you're the head of M&A and you get this tells you the story, and then you can dig in if you want to. But we have 1 minute, 30 seconds to 1 minute of their attention. And how do we get across what we need to get across? And AI isn't going to necessarily, you need to understand your audience in order to be able to, sit in that, understand the data, and then tell the story that needs to be told. And then if you fast forward, I, took that skill set to Juilliard. I, refined it, and I had an investment committee, and it was the same thing. And, understanding, sure, AI, anybody theoretically today can create reports, but it's understanding who is this investment committee, what's important to them, how are they going to, and then that human interaction of just being in an investment committee meeting and seeing how they react. Like, I often, in meetings today, or meetings, going back now to 2008, so, 15 plus years, like, think back to, like, as we're going through materials, what are their facial responses? How are they digesting this information? Do they have a confused look? Are they, do they just daze off into the sky, or are they really, like, digging in and writing notes? And so that's the piece for, advice to a Gen Z is you leverage AI to the biggest extent you can. I'm a victim of not having enough hours in the day to do that. I spend most of my day on Zooms. And so it means that I have my evenings to kind of find time to, use AI tools. My team, on the other hand, they leverage AI to, to the extent that they can, to leverage AI for sure. But you have to understand the data and the information and then figure out how to tell a story. So those Gen Zers that will graduate into being that, VP, the senior VP, the ones that do are going to figure that piece out. Or whether it's in investment banking or in the endowment foundation LP world, the people that graduate from analyst to associate to, director of investments to managing director to CIO, it's putting all of those pieces together. It's really, from the ground up, it's understanding the mechanics of everything. And that, it's something that we train in our people today. We're a small team, but like understanding the operations. What are the mechanics of an investment, whether it's a venture capital fund or a private equity fund or a real estate fund? What are the mechanics of this? How is performance calculated? How do you generate, how is an IRR calculated? Well, AI or Excel or anybody can do this. Do you understand the mechanics of it? You don't need, I'm not saying don't get a CFA, don't get a CAIA or an MBA, but you don't need those things to understand the mechanics, the operational backbone of an investment. But if you understand the operational backbone of an investment, then you can understand truly how performance is calculated, then how something's performing, and take that every step further. So those are the things that the people that graduate up through those levels are going to understand those things.
And to double click on that, a lot of this is like first principles thinking, which is like of, let's say, an IRR calculation or a TVPI calculation. What are the variables that influence the number in which you see? And there are many platforms. Let's say you're a GP, and there are many platforms like Carta, AngelList, like your fund admin provider, who can do the calculations for you. But if you don't understand the mechanics of how that number comes together, it really is detrimental. For example, this is a recent example I've come across where a GP had come to me and they're like, "Hey, in the last 5 years, I've have a 4 point something X TVPI, which is reasonably good for the last 5 years of a track record." I'm not saying it's too good to be true, but in some part of me, I was like, this seems really good compared to like everything else I've seen. Like in the last 5 years, I've seen anywhere from like 2 to 3x on the better side of things, and maybe like 1.5 to 1.8 to be like on the less so good side of things. But like at about like 5 years of a track record, give or take, was interesting. And so the biggest thing here is like, what is like valuation methodology? What's your, like, how do you think about valuations? Is your TVPI purely last round valuation, or are you doing some preemptive write downs because lemons ripen early, but maybe they haven't gotten repriced in the market since they've raised in 2021 or early 2022? And those kinds of questions, once we actually cut through the pure number of it, I think we ended up landing at, it was like a 2.8 or something like that, after doing what is a more thoughtful approach than purely like, I just took last round's valuation, and some of them haven't gone back to market in 3 years. But I also know some of them don't need to go back to market in 3 years, and some of them actually have to go back to market in 3 years. And the health of the portfolio has really declined since then. But that's an example of AI can probably tell you, here's the number. Like, here's the TVPI, DPI, IRR number. But if you don't actually know, like, if it's too good or not so good to be true, I think that's an example I kind of revisit often with people who are just entering in this world.
Yeah, 100%. I mean, it just goes back to what I say, understanding the mechanics of the investment, what's driving returns. It's something that we do. I mean, 7 or 8 years ago, 7 years ago, we started, almost 8 years ago, started fair market value drivers. What is driving, and we're a fund of funds, which means we have tons and tons of portfolio companies. But, we want to be able to explain to our investors what's driving returns. And so we started a fair market value drivers report, which every company, here's how it's driving returns, but it's understanding why that's calculated. Why did something go from this is 30% of fair market value to now it's 15? Or, if it's a company that, why hasn't it moved in 2 years? And so we track, when was the last mark, on this, both from maybe there's a potential for a co-investment opportunity, meaning if they haven't raised in 2 to 3 years, or maybe like, is this company really valued at what the last round was, from 3 or 4 years ago? So
minus maybe some of the obvious metrics that you would be looking at to understand fair market value, what are some of the underestimated, underappreciated metrics or variables that you might be looking at to understand the fair market value of the large portfolio in which you do have?
No, that's a good question, because, we back a lot of fund ones. in our portfolio, or we have over time. So, going back, I started investing in the asset class in 2012 alongside my partner, Patrick, while we were at the Children's Hospital Endowment, Cook Children's. And we were investing in fund ones. So, if you take the fund ones aside and the thesis around why we backed those fund ones, it's a whole different conversation. When they came back to market with fund two, in most cases, unless you were in the ZERP era of investing in venture, where everything was up and to the right in like a 6 to 18 month time frame from 2020 to 2022, before the market crash. Outside of that 18-month window, it was really hard to judge. I mean, we're back in that market today, AI being the exclusion and big name companies being the exclusion, where companies need to prove out their business model. So going from whether pre-seed to seed to Series A, we see true metric-based, investing, meaning Series A investors are looking for companies that have actually delivered on metrics, actually have revenue. So it's not just, I just want to get in at whatever price I can now before this gets too hot. And so when we started investing in venture, it was similar, meaning the average time between seed to Series A, let's just say it was 18 months and a company had to prove something. And so, if you then think about, we invested in a fund in 2012 and the next fund was coming back 2 years later or 3 years later. What are we judging it on? I mean, there was very little TVPI to show for, because most of these companies were just still very early in their evolution. So the easy piece is, metrics like TVPI, DPI, when you get long in the tooth. I would say 4, 5, 6 years in, I mean, Cambridge Associates, I mean, there's multiple benchmark and data providers out there, but, probably the most used are Cambridge Associates, PitchBook, maybe Preqin, Carta. Those are the ones that I can think of. And we look at all of them, but Cambridge Associates has a little asterisk of like, a manager's ultimate quartile generally they don't fit into their ultimate quartile generally until year 6, meaning, they could be bottom quartile and they don't even show performance for the first 3 in the Cambridge data, but then beyond that, they start showing them in which quartile. And so going way back to your question of like, what do you look for? We look at execution of business model. So we're looking at, when we backed a GP, what was our thesis around them? Why were we investing in them? And meaning we had a specific thesis. Are they tapping into a network or ecosystem that we feel is relevant? That could be Y Combinator, just as a good example. We wanted access to Y Combinator and, call it the top decile of companies coming out of Y Combinator. And, in 2015, we backed a GP that, was one of the first movers on backing companies out of YC. And by that, I mean, some of the people were ex-YC founders. So they had an inside track to backing YC companies. So what network ecosystem are they tapping into? That's a part of our original underwriting. What's their edge in winning deals? What is their original thesis on portfolio construction? Do I want a 30 to 40 portfolio company? What's my average ownership? What's the value add that I'm giving these founders from seed to Series A? And so when they come back to market, it's going back to that original thesis and understanding outside of TVPI or any other financial metric, how do they execute on this original thesis? So the easiest is portfolio construction. They targeted and they set out to have 5 to 7% average ownership per position. And if they didn't get it, that means that they're getting to the deal late. They're not getting, they're not seeing the company first. Or, I mean, and the reasons why they didn't get it could be, I guess, anything. But, it's understanding why they didn't get the target ownership that they, set out to be. And then beyond that, digging in further on what their value add is. So there's a lot of venture is in 2012, when we started investing in venture, it was like no other asset class that I'd invested in. When I was at Juilliard from 2008 to 2011, it was a hedge fund heavy portfolio. So I understood a lot of quantitative driven metrics. Ultimately, it's about the person, are you backing an XYZ hedge fund because of the, who the person is, and do you think this person is going to make money for you? But beyond that, there's a lot of metrics that there's a lot of data analytics that you can do around hedge funds. And even private equity, real estate, there's more quantitative measures. And in 2012, when Patrick and I started building out venture at the Endowment, it was just different. It's a lot of qualitative measuring versus quantitative. And so, it takes a very long time to see results in a venture fund. And so there are a lot of small qualitative measures that you have to think about. And so as part of the initial underwriting, we're thinking about that because we know they're going to come back to market before anything is really shown on paper.
They'll come back to you in 18, 24 months.
Yeah. And we're going to have to make a decision again.
Yeah. What were some of the qualitative metrics? Like one thing you mentioned was discipline, right? If they come back to you in fund 2 and they said 5 to 7% ownership, they didn't hit 5 to 7, they hit 3% ownership, average ownership, then you're like, all right, something didn't go right. Was it an over expectation, or was it like an under delivery, or a combination of both, right? And that might be many influences there. What are some of the other qualitative things? Because back in 2011 and 2012, these were, I imagine, and feel free to correct me if I'm wrong here, these were new relationships. You mentioned you had a hedge fund heavy portfolio. And so for the most part, you were building potentially a lot of new relationships with managers and hoping to bet on them for a reasonably long period of time without without much of a track record to go with them. What did you look for when you were making that first commitment?
Our thesis in 2012 was we don't have access to a lot of the brand name firms, like Sequoia, like Benchmark, so on and so forth.
Why didn't you think you had access? Was it a function of check size or a function of like the relationships that had yet to be built?
They had yet to be built.
Okay.
We didn't try. We were starting with a blank sheet of paper. They're sort of forever closed firms, meaning they have their LP base. They can raise their next fund and even raise more money and their existing LP base. And we had yet to really try. I could have gone and be like, we work for a children's hospital and we do good in the world. But in order to build a venture portfolio, I mean, it would have taken years and to get the exposure to a brand name portfolio. And there's nothing wrong with that. But, we saw an opportunity in 2012 where investors were kind of running the other way from the asset class. There was no different than the market today. There was an illiquidity overhang across asset classes from like the 07, 08 vintages of private equity, or every illiquid asset class from the financial crisis. The venture asset class, like the 03, 04 post.com era vintages, had yet to return very much capital. The IPO window hadn't really opened. And so investors, similar to really 23, 24 timeframe, investors were running the other way saying, is the illiquidity premium worth it? And it really wasn't until, May 2012 when Facebook went public that, investors were like, oh man, these returns really are worth it when you stick around and wait. So that was our catalyst. And our catalyst, if everybody's running the other way, running from the fire, let's run into it. And, there's probably an opportunity here. And so could we probably have built some of that access? Yes. Probably another big tenet of like why we built venture the way we built it was, we were fortunate at the Children's Hospital and now with investors, but, we were fortunate at the Children's Hospital. We had full discretion of the portfolio, and we would send a memo to the investment committee of the investments we were making, and we would report to that investment committee on a quarterly basis and tell them here's how the investment portfolio is doing. And I never, Patrick and I never wanted to walk into an investment committee meeting not being able to explain how or why we made or lost money in a given quarter or year. And we never wanted to be blindsided either by any given manager. So when you think about the brand name firms, they are iconic firms, they're iconic names. We love the fact that they're co-invested alongside of us. Even if we could build relationships with those firms, we didn't feel like we were going to get the transparency. Maybe it was because of our check size, but maybe that's just because of how they operate, that we needed to go to an investment company to be like, here's how XYZ brand name venture firm is investing, and this is what they've invested in. This is why, we're up 30% this year because we're in this company. And the transparency at the brand name firm level is not as high or as much, or not to our standard as it is with the kinds of firms we back. Now, I don't know if it's because of the kinds of the firms we back, or is it because we built relationships with these GPs in 2012 when there were half a dozen to a dozen institutional investors in the space. But we built those relationships with GPs, and we continue to build that today, where we get board level transparency on what's going on with companies. So I don't have an investment committee. I have full discretion over my portfolios today. Patrick and I make decisions on behalf of our investors every single day, but I can go to any investor and tell them and talk to them about, here's why our returns were, here's why our marks in our portfolio went, from 2.5 to 2.75 this quarter. Or, here's why our marks went from 3.5 to 2.75, call it in the correction kind of, post repair. And we know exactly why. We know exactly the underlying fundamentals of a business. So it's one thing for a mark to just go down. Somebody marked a company down, but I can talk about the fundamentals of XYZ company or ABC company. I'm like, yeah, it was a right thing to do to mark it down, or this company hasn't been marked down in 5 years and they haven't raised capital in 5 years, but here's the underlying fundamentals of why that business is where it is. And so we built out venture in a way beyond the point of, did we have access? Could we have had access? We wanted to invest in a way where, we had transparency and we had that relationship with GPs where we could, learn and understand, exactly what we're investing in. We felt that kind of the seeds, pre-seed and seed stage was, historically early stage venture is the best performing segment of venture capital. The brand name firms, our thesis started in 2012 that the brand name firms were going to get bigger. Nowhere in our thesis, and we still have our original investment memo of from 2012. Nowhere in our thesis do we think everyone's going to start turning into RIAs. Was
there writing in the wall now that you've with the hindsight bias in which you do have?
There was nothing. We just thought they were going to get bigger and invest more downstream. So mid-stage, I didn't think they were going to go late stage, secondary, RIA. No, there was nothing.
Okay.
With hindsight, I wouldn't have seen it. But our thesis was, let's just back people that are tapping into US at the earliest stages, the ecosystems and networks that matter. And we started identifying those ecosystems, PayPal Mafia, Y Combinator, the universities, and we started identifying which of those ecosystems with help. It wasn't
who did you ask?
We didn't have help.
Help from who did you leverage on in terms of to understand the ecosystem?
I mean, one of the first managers we backed was Ray Tonsing, Caffeinated Capital. And, Ray was super helpful in opening doors to his network and people that he thought were relevant. Ron Conway from SB Angel, he was super helpful for us. I mean, he opened a lot of doors. I would say, when I look back at our legacy portfolio, Ron introduced us to a ton of managers of like, here's who I like investing alongside of. And, and just, so that was, we got connected to Ron, in 2012 or 2013. And just kind of, we were one of the very few institutions that could move quickly. Like the reason why founders like solo GPs, meaning they can make decisions quickly and move fast, and there's no friction. We were like that as an LP.
What was the context of, like, for an endowment foundation, which you guys were at? What is the context of quick? Was it like 3 weeks, 1 month? Like, what were we talking about in terms of quick?
It could be as quick as 1 month, a couple weeks. But I think it's more of, we could come out of a meeting and say, hey, we want to do this. Now we have to finish our work, whether it's background checks, legal due diligence, whatever, but we're going to do this. And so, but most people can't come out of an endowment meeting with that clarity, where we would say, if we said we're going to do it, we're going to do it. And then it's just, so long as everything else checks out, legal, legal review, et cetera. But
the discipline of just, so like,
it could,
yeah.
And so we could give that yes, no at the end of a meeting, theoretically, which we did. We would do from time to time. So
what were you looking for in those, like, first meetings where you're just like, all right, were you looking for the spark? Were you looking for, like, people these days talk about sourcing, picking, winning, blah, 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 those kind of things. What stood out? You did half a dozen investments.
No, we did a dozen or so GPs. I mean, then it's easier to say now what we're looking for. Although, I was in a meeting with an investor in August, an existing investor, one of our anchor investors, which is an institution in Houston. And they're like, what are you guys looking for now when you find these? Because we have a segment of our portfolio we call scouts. A scout is a brand new, GP, generally a fund one. And they're like, what are you looking for? You invest in 6-8 in a vintage. How many do you meet, and what's the bar to get in? I'd say what we're looking for now is much easier, because there's not a lot of white space left. And when I say white space, we've got a core portfolio of a dozen GPs that we feel are the best of breed. They're somewhere between Fund 3 to Fund 5 at this point. They've proven out now, not just in qualitative metrics, but quantitative metrics, that they are that best of breed. They've shown discipline in fund size. They've shown discipline in ownership and valuation. If they haven't, then they're not in our portfolio anymore. But the 12 that are in any existing fund in our portfolio, they've shown all of that stuff. They cover ecosystems and networks that we think are relevant. And so that is what we think encapsulates the venture market, or the US venture market. So there isn't a lot of white space. So then you've got this scout portion of our portfolio, which is another 6 to 8 managers in any given vintage. So it's hard to find white space. So when we find a manager that is in a white space that we think is relevant, then that's like signal number one. Like, okay, this is interesting. We don't have exposure to this. Or it could be they cover a space that's covered in our portfolio. Meaning we've got a GP in our portfolio that exclusively does Y Combinator. And, we meet a new GP that exclusively does Y Combinator. They're brand new. And so why is this one, we want to understand why this is better than what's in our core portfolio, where I have a decade-long relationship. So then it's either they cover white space that we're not covering, or they're covering a space that we are. The easy answer is it's Patrick and I know within 30 minutes if we're going to back a manager or not. I mean, it is that instantaneous for us of, after, 15 plus years of looking at managers, 13 years of looking at venture managers. We just know immediately, that there's something in this person that makes them different and special. There's a spark, and it's hard. It is not about anything else. That's why we're able to make that decision quickly, because after you've looked at manager over manager over manager, you can just tell that there's something, this person is wired differently and they're going to be an outlier in returns, or just an outlier GP. I don't, we think about it in relationships, not returns only. And so, but back then, just going back to your question, I don't know. I mean, we had, everything was white space. So it was really building around networks and ecosystems. And there's certainly misses. We passed on things that have done well. The people that we backed have all done well. So we have a good hit rate on, actual investments. I mean, everybody that we backed since 2012 is still in business today and still raising institutional capital. But we certainly missed things of like, I don't like that because it's two GPs and I don't really understand, who's adding the value. So we passed, but they did well. I mean, so there's certainly things that we missed. But it was easier then because the landscape was less crowded. There were 150 backable to quasi-backable seed funds in the market in 2012. I don't know, 2,000, 3,000 now, backable to quasi-backable seed funds in the market. So it was easier then to figure out, what we were looking for, if you will, because it was just brand new.
Yeah. Everything was still very much cottage-like, and to your point, a lot of white space. I know we're coming up on time here, and Apurva, this has been such a fun and interesting discussion, but as we round out at the corner, I'd love to ask you just kind of take a step back from all the venture LP stuff. And I'd love to ask you a couple questions that just bring us back to earth a little bit more. And if this hits a dead end, I'll take complete blame on this because these are the questions I didn't send your way. And so we'll see how this lands. What heartstrings does the annual ugly holiday sweater tradition pull on? And how does that differ from your everlasting interest in college football?
I love attending sporting events. Tennis, I will actually sit and watch on TV. We've hosted, let me take a step back. We love building a community around what we do and where we are. So the firm is headquartered in Fort Worth, Texas. We have a lot of LPs here. College football is big, I guess, across the country, but in general, is big in Fort Worth. And so we've hosted a bunch of college football events over the last couple of years. I love the holiday season, I guess, in general. Since a kid, I've loved the holiday season. When we were at the Endowment, Patrick and I would invite all of the GPs across every asset class to Fort Worth, and we'd host a ugly sweater holiday party. So before Summit Peak, we used to build a community around what we do. We would do it in venture. I would do it in New York across allocators, so across LPs. And so when we started Summit Peak, it was just a natural extension of what we were already doing. And then, we host community dinners on a, monthly or, every 2 months, but generally monthly. And so the December one is just a way to get into the festive season. And so we love seeing, we have prizes, who has the ugliest sweater. So last year we did Fort Worth, San Francisco, and LA ugly sweaters. And so this year we just said, a lot of people are moving back to San Francisco. We had a lot of GPs in LA and a lot of people are moving back. And so we said, why don't we just do one? And then, we love hanging out with our GPs and they love hanging out with us. So why don't we make an annual meeting of it? We wanted to do our first one in April of 2020. We had it all booked at the Palace Hotel.
Oh, and we all know how that turned out.
And so that was supposed to be our first annual meeting. We've done Zoom town halls annually in a similar format, but it's just nice to get, like I said earlier, like we're an in-person. As much as we're remote, we love being in person with our investors and our GPs. So this is a great way to combine our Zoom town hall that we do with our ugly sweater tradition.
I love it. It's the natural multiverse of two worlds, but very similar worlds in and of itself. Last question to you, like, was there an ugly sweater that you think that you wore or that you saw that you think deserves more attention and potentially fandom, but didn't win the ugly sweater contest?
Oh, I don't know. So we have independent judges for the ugly sweater competition. So we asked the staff, whoever's at whatever restaurant or, wherever we're hosting a party, we asked the staff to be judges. And so I actually don't, there have been some good ones. Some really bad, ugly ones, some really creative ones. I think the year before, one of our GPs in LA, he made his ugly sweater and it was
Wow.
half nerdy. Like there was, formulas and words and like stuff pinned on. So it was so one of our GPs did that. We've got the traditional ones that you can get on Amazon, like the llamas and,
Yeah.
I think there's been an ugly suit. So someone's worn an ugly suit. And then one of our friends in Dallas has like a whole ugly sweater dress thing. So I don't know. There's been some standouts for sure.
Oh, that is fascinating. All right. We are at time and I want to be cognizant. So because you live a busy day, this has been so much fun. Apurva, thank you so much. And thanks for joining us.
No, thank you. Thank you for having me. This has been awesome. I really appreciate it, David.
All right. We'll see you soon, Superclusters. So, Apurva, when we last caught up, you told me something very, very interesting. And so I don't want to bury the lead here. I want you to deliver the punchline. But what is the marriage between SPVs, license plates, and GFW?
It's a great question. So when we started raising sidecar vehicles in 2020, so March of 2020 was our first sidecar vehicle. We named the vehicle the company that we were investing in. And then a year later, we had to register with the SEC and, we were going to have all these different filings. And we realized, all right, we didn't necessarily want all of our company information of where we were investing out in the public. And so we decided to start naming our vehicles after mountains. So naturally, Summit Peak is a mountain, which someday Patrick and I will climb. And so every SPV that we've done, which we have 29 of them today, has a significance of a mountain. So as an example, we're invested in Lattice, which is Jack Altman's a company that Jack Altman founded, and Jack and his brothers are from Missouri, and Tomsock is the highest peak, which is not a very high peak, but it's the highest peak in Missouri, and so our SPV is named Tomsock, SP Tomsock, and so at some point in time, I said, some of these SPVs are going to have really great exits. We underwrite that our sidecar vehicles, with the hope of like, hey, these can be 10x plus outcomes. They're not all going to be that way. That's my SEC disclaimer right there. But so that's the marriage of Summit Peak, our sidecar vehicles, and license plates. So I have a wall of license plates that I've that have different. They all say SP and then something on them. And there's one that's unique that isn't a mountain, and it says SPGFW. And it's been a running joke, now since 2018, since really starting the business, which, that year, Patrick and I were still at the Endowment, and I received a voicemail, and this was, old school. People called a landline phone. You get a voicemail, which you either dial into, or maybe it was electronic that I would go into my my email inbox, and I received a voicemail from, and context, as we manage money across asset classes. So, received calls for all kinds of different things. So this, being in Fort Worth, Texas made sense. It was an oil and gas guy from Oklahoma that was calling about an oil and gas deal. And, the voicemail is, pretty iconic in terms of just, what you would maybe expect in Texas. And he's selling, the world's best oil and gas deal. And in that, he talks about, look, you can within a week or within a month make generational fucking wealth. And so from that point onwards, and so we forwarded it around to all of our friends. A lot of our investors know about it, and everyone started using the acronym GFW. And so we have one SPV that is in the crypto space, and we were like, man, this is either a 0 or it's like 100x. And so this is generational, generational fucking wealth. And so I have a license plate that says SPGFW on it. And so it is with our investors now, when we call about a deal, they'll be like, is this GFW? And so so we have, there's a lot of investors that know about the GFW story, and so that's the license plate, and that's the history behind it.
I freaking love it. And now you don't have to forward that voicemail anymore because we will play it right here. So without further ado, cue the clip.
Hey, this message is for real Americans like Katie or Kate. I'll cut to the quicker things. I'm an oil man. I poke holes in the ground and I recover minerals, and I make people generational fucking wealth. I change lives. I'm sitting on a deal right now in Washington carrying where these guys don't know what they're sitting on. They don't know what they have, and we're about to take it to the house. Now listen, I'm looking for a few very small angel investors to get in on this deal to finish the project off, and I'm calling you because I heard you're serious now. What I'm looking for is $10, $20, maybe $200,000 to finish this deal off. By the end of the week, you'll have your money back. By the end of the month, your children's education will be paid for, and by the end of the year, you'll be retired and sitting on generational fucking wealth. Now you talk to my receptionist, you talk to Stacy, Tracy, Casey, Macy, or Jennifer. We'll put this deal together, and I'm going to change your life. And you call me back now. All right, then.
Hey, Superclusters fans, you made it past the snap. You didn't disappear yet, so I have a mini message for you. If you enjoyed today's episode, if I might be so bold, I have 2 favors to ask of you. 1, there's a little red subscribe button if you're on YouTube. If you liked what you heard today, that's the oxygen for this podcast. And I promise you, we will do our best so that you get the most profound questions answered by the most experienced allocators. 2, and lastly, I know every single one of you knows something I don't, and a question I've never thought to ever ask. So I'd love to hear your thoughts and curiosities down in the comments. So the next time you tune in, you hear the answers to the questions you would like to know. I promised myself I'd record 100 episodes of Superclusters, so every comment, question, review helps me make this experience more meaningful and helpful to you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I want to share a quick disclaimer. The views expressed in this podcast are for informational and educational purposes only, and are solely the views of myself and the guest alone. They are not representative of any organization that we are a part of. None of the views expressed here constitute legal, investment, tax, or business advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. So that's it from me. If you want more of this, the left video is something we think you'll really like, and the right one is our latest one if you haven't seen it yet.